Hi everyone! Welcome to our channel, where we break down complex insurance topics into simple, easy-to-understand concepts. Today, we're diving into some of the most important principles you'll need to know for your insurance license exam. Whether you're studying for the first time or just need a refresher, this video will cover everything you need to know about the principle of indemnity, the law of large numbers, adverse selection, perils, loss and hazards, and risk management. Let's get started. 1. Principle of indemnity, indemnification. The principle of indemnity is all about restoring the insured to the same financial position they were in before the loss occurred. In other words, insurance is meant to compensate, not to profit. For example, if your house burns down, your insurance will pay to rebuild it, but you won't get more money than the actual value of the house. Key point: insurance contracts indemnify the insured. They don't allow you to gain from a loss. Exception: life insurance is a bit different. It's a valued contract, meaning it pays a predetermined amount, regardless of the actual loss. 2. Law of large numbers, spread of risk. The law of large numbers is a statistical principle that helps insurers predict losses more accurately. The idea is simple. The larger the group of similar risks, the easier it is to predict future losses. Example: imagine an insurance company insures 100,000 homes against fire. If only 100 homes were insured and 5 burned down, the company might go bankrupt. But with 100,000 homes, the risk is spread out, making losses more predictable and manageable. Key point: this is why insurers prefer large groups. It's all about spreading the risk. 3. Adverse selection. Adverse selection happens when higher-risk individuals are more likely to seek insurance. This can be a problem for insurers because they might end up paying more in claims than they collect in premiums. Example: a person with a history of car accidents is more likely to buy car insurance than a safe driver. Solution: insurers use underwriting to assess risk and charge higher premiums for higher-risk individuals. They also insure large groups to balance out the risk. 4. Perils, loss, and hazards. Let's break this down into 3 parts. Perils, loss, and hazards. Perils, causes of loss. A peril is the immediate cause of a loss, like a fire, theft, or accident. Named perils versus open perils. Named perils policies list specific causes of loss, e.g., fire, lightning. Open perils policies cover everything except what's explicitly excluded. Loss. A loss is an unintended reduction in value, like a car being totaled in an accident. Direct loss versus indirect loss. Direct loss, the immediate damage, e.g. a house burning down. Indirect loss, the consequences of the direct loss, e.g. losing income because the house is uninhabitable. Hazards. A hazard is something that increases the chance of a peril occurring. There are 3 types. 1. Physical hazards. Tangible conditions like icy roads or poor health. 2. Moral hazards. Dishonest behavior like lying on an insurance application. 3. Morale hazards. Carelessness, like leaving your car unlocked because it's insured. 5. Risk. Risk is the uncertainty of loss. There are 2 main types. 1. Speculative risk. Involves both gain and loss, e.g. gambling or investing. 2. Pure risk involves only the possibility of loss, e.g. illness or injury. Key point: only pure risks are insurable. 6. Elements of an insurable risk. Not all risks are insurable. For a risk to be insurable, it must meet these criteria. 1. Due to chance. The loss must be accidental. 2. Definite and measurable. The time, place, and amount of loss must be clear. 3. Predictable. Insurers must be able to estimate future losses. 4. Not catastrophic. The loss must be manageable for the insurer. 5. Economically feasible. The premium must be affordable compared to the potential loss. 7. Risk management. Risk management is the process of identifying and handling risks. Here are the main methods. 1. Risk sharing. Spreading risk among multiple parties, e.g. coinsurance. 2. Risk transfer. Transferring risk to another party, e.g. buying insurance. 3. Risk avoidance. Eliminating the risk entirely, e.g. not skydiving. 4. Risk reduction. Taking steps to minimize the risk, e.g. installing smoke alarms. 5. Risk retention. accepting some risk yourself, e.g. choosing a high deductible. Pro tip, remember the acronym STAR, shared, transferred, avoided, reduction, retention. And that's it! You now have a solid understanding of these key insurance principles. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you don't miss any future videos. Good luck on your insurance license exam, and I'll see you in the next video.